Good weekend, all. Ira Epstein, and here's your weekend edition of the financial markets. And this is your wrap up with weekly charts rather than daily charts. I'm putting this out Saturday, the 5th of April, 2025. There's no big economic data due out on Monday. I think we all need a break from that anyways, but we'll be dealing with the tariff fallout. We'll be dealing with still the comeback from China, going to a 34% tariffs on the United States, in addition to other tariffs they also have in place. So it's tit for tat. And with that tit for tat, you slam down the energy markets. You know, the world's worried. Everybody's going into a recession with this. You put on a dramatic bids in the bonds and the notes. You've taken down the 10-year notes at about 10%. Gold dropped dramatically as eventually when profit takers started coming in, and they will at some point. And you have to ask yourself, why is gold down $86 with all this? And I'm giving you, at some point, profit taking was overdue. Silver was down $2.70. Copper market down nearly 43 cents, $42 lower in the platinum, and the dollar reversed course. A lot of this is Friday. A lot of people just wanted to grab whatever they wanted to grab, get into a Friday action. But what you've set up now is you have two markets officially, by chart analysis, in bear territory. You got the Nasdaq and you've got the Russell. They're both 20% off their peak. Now, if you get my newsletter, you're going to see what happens 1 week, 4 weeks, 3 months after you enter bear territory. And I give you the historical parts to this going back into the 1970s. So it's every time that's happened, what has historically happened. You want to see that, I think. It's going to be interesting reading. In the grain markets, interesting day. The soybeans, which China does buy from the United States from time to time, down 35 cents, but corn higher by 2. Corn, a lot of it doesn't get sold there. And the market's telling you, don't be short corn. If you're going to sell on rallies, you can sell the beans. That's just what the market said after this all came out. That's my interpretation. Now, when we look at a monthly area chart of closes, and please understand, we're 3 days into the month. That's all. You're down 9.61% on a closing basis. And this is the first move back under the 18-month moving average of closes. When we come to the weekly area chart of closes, and this is, again, the 18-week moving average, you're down sharply from there, and you can see how this market's come down. Get much further lower, and traders will say, we've entered bear territory in the S&P. You can see how the market has plunged down. We've been here, done this before. This was the last break. If it wants to go all the way down, could it go back to the 4,000 level? It could. That'd be stretching it. Let's assume it's got another 5 to 10% in it. That could easily be the 4,800, or you may walk in Monday and get a different world. Why? Let's take a look. First, the trend is down. You have lower highs, lower lows plunging on you. Number 2, this is the first challenge of the 100-week moving average of closes. I teach that often you hit major moving averages, and it's important. Now, that's a 2-year, if you think about it, average. 52 weeks, 100 weeks, that's 2 years, right? 52 weeks to a year. And down here, right below you, the reason I said the 4,800 zone, the 200-week moving average is there. The Bollinger Band cannot offer you support. You're under it by a lot. So it's not the supporting character. What's supporting about it is you only stay under it 5% of the time. That's the supporting part of it. The second thing that supports this market to a degree is it's oversold. That comes into play. And again, you want to take a look at my newsletter for what typically happens historically. That's all I'm saying. At the week after you enter bear market territory, I'll make you go to our website and be sure to get free offers or subscribe, and you'll get, these are the type of things I put out for my clients. When we look at the Dow Jones, lower highs, lower lows, same thing. Your test right down here, market is not embedded. You haven't embedded in the Dow, the Nasdaq, or the S&P for years on end. You do regularly, even on weekly charts, much more regularly than you do in the other indices, in the Russell 2000. So this market's also at an extreme, so you might get a bounce. When you come to the Nasdaq, you can see where you're at right now in this market. And the Russell, look, down and under everything. So there's nothing left under this market. You're under the 200 week, you're under the 100, you're under everything. So it's just a meltdown. And if any of the markets are going to approach an embedded status again, you have both numbers under 20 this week. You've got them under 20 right here and 20 there. You are now embedded in that market, which tells me that rally's back to maybe the lower Bollinger Band, which is right here at the 1922 level, but that'll drop sharply on Monday, just the way the math's going to work. That could be the area the market goes up to and stalls a little bit. Will we walk in Monday and see short covering? Or will you walk in Monday and people are looking at their portfolios over the weekend, margin calls, that's for certain if there are people in this market that held on and they use heavy margin. That's going to be there. So I wouldn't be surprised if you open lower and then the game begins. What's the next play? When you look at the DAX, you can see how the market has now come down, and it's fighting now. It's going to fight, in my belief, at the 18-week average of closes. So I realize all that talk that Europe's the place you want to be, but this market has just come from 41.55 down to 3,600. It's not a big break. All right, so you're sitting here with a 10% drop in the market. It's a normal corrective territory move. When we look at the 5-year Treasury notes, we can see the market's up and over the upper Bollinger Bands. Remember, in bands, whether they're weekly charts, daily charts, you only stay over bands 5% of the time. The problem is, let's assume you stay over the band another week. Well, that's another 5 business days on the daily chart that it could be. Got it? So you always want to look at the daily chart, not the weekly, when using that first. When I look at the chart, though, I say it's over it. Maybe it can make a run to the 200-week moving average, but I think that would stop this rally in its tracks right off the bat. I feel the same thing in the 10-year. If it gets up there, I look for the market to fight a battle there. In the dollar, well, the dollar got down to the combination. First, it went to the 100-day average. 100-week average. We're on a weekly chart. I'm so used to saying day with you. We went here. You hit that the week of March 7th. You then played with it. You didn't just fall apart. Now the question is, you're oversold. If you drop again, and don't get back in the Bollinger Band, 102.18, the 200-week moving average comes into play. The market the week after, and this is the week of the 21st, gets inside the band. It's not able to make it back to the 100-week. You can see that. And then the market comes up, hits everything. This is the week of the 28th. So I just want to show you the theory that I have and how at times it really plays out. So there's your resistance points. Now, anything can happen next. No way to know. I will argue, though, that if it lets go, potential support is the combination of wherever the Bollinger Band comes in and the 200-week average in that light gray. You went down to it, went through it, and you came back in it again. That's all that I'm saying. So that gives you an idea that the professionals aren't pounding the dollar and just saying, oh, it has massively lower to go. They keep covering their shorts, and that's why the market comes back or new buying is coming in. In the euro, it's the exact flip-flop, so I won't do it every day. But you got through the 200 and the 100. You went up, you came down to test them, and you went back up, but you're staying right at the Bollinger Band. The euro's in an uptrend, a very clear one. Canadian dollar, back in an uptrend on a weekly basis. It took all this to get it done. It was there when? Last week. I'll just give you an example. You can't argue higher lows, higher highs, and you were over it. As long as you don't get back under this number, I'm looking for the market to be all right. And the market did not, and that's how you ended up. What stopped the rally? Again, Bollinger Bands. Learn how to work with these Bollinger Bands. They're so darn important. You have to learn the formation here when markets tighten and then run the band, what we call the gorilla glue trade, where it tries to force the market to embed. That's crucial in markets. In the Japanese yen, 2 currency plays became safe havens very clearly this week. Swiss franc, Japanese yen. Both are the stellar gainers that were for the week. In Bitcoin, Bitcoin unhinged itself from the NASDAQ. It's been running, and I've mentioned it over and over on the daily updates, that if the NASDAQ's down sharp, generally that's the case in the Bitcoin. That wasn't the case. They broke apart the latter part of this week, and you were actually up for the week $1.50, $150, if you will, a coin, and you were down sharply in the NASDAQ. So you've broken the two away from each other, which I think is friendly Bitcoin. It's not in a bull move yet, but it is friendly. The differential between the crude prices of Brent and WTI just sort of sitting here at 358. Then you let go in everything. So two events happen at the end of the week on energies that have to get you concerned. First, obviously, OPEC has decided to pick a fight with other members they can't get to control. Kazakhstan is one. They keep saying certain countries, oh, they're going to cut, and they keep overproducing. So 8 members finally said, we're done keeping our cuts on the market to help the United States, for one, steal market share. No, and by the way, our grades of oil are different, but theory. Number 2, other OPEC members with similar share just keep producing while we're cutting it back to help them. That doesn't make sense. So out of left field, and nobody saw this coming that I'm aware of, they said, we're going to produce, instead of the 130,000 barrels more a day in the month of April, we'll keep that. But in May, we're going to go for 430,000 barrels a day. And we'll meet in May, June, and we'll decide, should we even put more out on the market? Now, this is in the face of the tariff war taking place, in the middle of it. And then China comes out, puts a 34% tariff on U.S. goods. That just did the market in. The market just said, hold on, we're in a full-fledged tariff war. Recession words are coming out. How hard are markets going to crack? The big buyer of the world, us, the United States, it's going to be harder to sell to them from goods abroad. Do we need all that energy with more coming on the market? That was what was said, and that took these markets down. WTI also. Now, as you take down these energy prices, there's calls that I'm reading for $50 energy off of all these tariff wars and the possible recession word, all that coming. I couldn't argue that. It won't affect natural gas as much. Didn't say it won't affect it as much. Because as you get down to these prices, the idea that you're going to bring on more and more wells and produce more and more isn't the story in the United States. It'll be the opposite. We're going to hold off a little bit, see what the markets are going to do. Well, that's less gas production because most oil wells put out natural gas. We do have natural gas wells, you know that. So there's plenty of that still there. But that's why, in a relative basis, nat gas was holding up, because if you cut a lot of this, you have less supply of that. In gasoline, I've been telling you that I wanted the market to come back to the 18-week moving average. I thought the $2 area was important. Do you remember that my last report, and I'll have to do another one now, my last special update was on gasoline. And I clearly said, you don't buy, you are getting overbought. And that was 3 weeks ago. You were about here. Now you're back to the zone I'm interested in, and I'll leave it at that, all right? Because I am interested in it. You put it together, what do? Well, right now, what you learn how to do is work with this, my enhanced Bollinger Band course. Go to iraepstein.com, education, can't miss it. Take a look at these courses. If you ever needed them, my guess is you need them right now to understand this important technical tool. It's a short course. It's all video. You get with it my updates, my written, my video updates. You get the charting software you see me using here, and it's inexpensive. I'm Ira. You have yourself a great weekend. I'll catch up with you all Monday morning.